Hello and welcome to this webinar. We are so excited that you've tuned in. I am Ben Brundage. I head up our investor relations here at Aspen Funds. And this webinar, Investable Megatrends for the Next Decade, is hosted by Bob Frazier, Aspen's CEO, and Ben Frazier, Aspen's CIO. Bob has over a 20-year background in finance. He has pored over the data over these past few years and is looking forward into what's to come. So it's going to be really exciting to see where we are and where we're going. Ben has a background in underwriting at a high caliber asset manager and in commercial banking. He is on the ground and knows exactly what's going on in so many asset classes here today. So without further ado, Bob and Ben.
Thanks, Ben. Hello, welcome to everyone joining us. I'm pretty excited about this. This is a presentation that Bob has been doing, kind of making the circuit on podcasts, on different events, and the reception has just been very, very well received from investors, and just the questions, right? There's a lot going on in the economy right now. Where are we going? And
how do you survive this? How do you make money? So we want to answer really some of those key questions in this day and age, and take questions as well. So
right. So I'm going to just jump into the agenda here so you know exactly what we're going to be talking about. This is being recorded. So if you have to jump off a little early, no problem. We will be sending the recording afterwards. And first, we've had an amazing response, a lot of new faces that are here. And we want to give a little bit of background on who Aspen is. So you may have heard of Aspen Funds, you may not have. We want to give you a little bit of context for who we are and really what we're doing and where we're trying to add value. Then we're going to dive into the data. So if you don't know Bob, or myself, we love data. We are data nerds. We're going to try and keep it, at a high level and really talk about what's going on, but we've got a lot of slides. And then finally, we're going to try and carve out a good amount of time at the end for Q&A. And so we want to, run through these slides, but then leave a good amount of time to answer questions. That's one of the benefits of doing this live. We know people have a lot of questions going into the end of the year and into next year, and a lot of fears of recession and really where we find opportunities. And so this presentation is hopefully going to give you some inspiration, some hope, and some excitement about where there actually is some really positive trends going on and where as investors we can position ourselves to be successful.
Sweet. All right, I'm going to jump in a little bit of who Aspen is. So my name is Bob Frazier. As Ben said, 20 years in finance. My background is in technology. I'm a magna cum laude graduate in computer science from UC Berkeley. Worked as a coder for many years and started at .com many years ago. Raised $44 million in venture capital and blew that up, but really became a finance guy and a passion for economics and to study economics and to know how to make money in whatever the economy is throwing at us, right? Whatever cards are being dealt. Jim, my co-founder, is an expert in real estate. It also has an oil and gas background. Dan Schulte is one of our managing directors, is a venture capitalist and was a former general counsel for Waddell & Reed, and has quite a bit of experience in pretty much all areas of private equity. And then Ben is, as Ben said, was a former banker. And bankers, really know how to manage risk, and that's their thing. So Ben comes with a really good analyst background and risk. One of our flagship fund, I guess you would say, is Aspen Income Fund, 10 years experience. It's a 9% yield, over $60 million in investor capital managed. And it's just an amazing little rocket ship. And for people that are looking for income. Now, what I'm going to share this time is really investable megatrends. And I'm going to show you why I'm so passionate about this. So a little bit of my story. I started a .com back in the 1990s, literally in my attic with my sister-in-law and $100,000 from mom, and raised $44 million in venture capital, grew it up to 300 employees, and ended up winning the Ernst & Young Entrepreneur of the Year Award in 2000, and became the fastest growing business in the entire Midwest region of the United States during the late 90s. And then when the .com crash happened, I lost everything. And so what I became passionate to understand is to understand economics and to be able to go with the tides. So what I learned, number one, is follow the tides. So in the 1990s, it didn't matter how bad your .com was. You could have the worst .com in the world and it went up. right? In 2001, you could have the best.com and it went down. I mean, Amazon.com, no kidding, was selling for 30 cents per share. Okay. So it didn't matter how good it was. And so the whole point here is when the tides come in, all boats float, even the bad boats. And when the tide goes out, all boats sink. So what we want to do is understand the tides. And that's what this presentation is about, is some of the tides that are going on. And so what I love about tides is I don't have to be a perfect boat picker, right? I can make mistakes in picking my boat. And not that I'm going to try to, I'm going to try and really pick the right boat.
Right.
But even if I'm wrong, if I get the tides right, my boat's going to be just fine. So we want to understand what's happening on the planet and how to make money doing it. So the second thing I learned in 2001 is go private. And what do I mean by that? Well, when I say you should buy real estate or invest in real estate, people think, well, let me buy a real estate investment trust in the stock market. Well, that is not private. That's a public company. And go private means if you want to own real estate, then buy real estate. Okay. Don't buy a real estate sausage in the public market. So go private. Private investments are far superior. And so our passion as in Aspen here is to help people kind of make private investments approachable, make them understandable, understand how to manage the risks and how to invest in private investments. And just as an example, here I have, this is just a couple recent real estate funds, these guys. And they have a certain PE. Well, PE is the price to earnings ratio. And what that really is the number of years to earn your investment back. So if you invested in American Tower, it'd take you 38 years to get your money back, to earn your money back on that deal. Anybody excited about that? Not me. Okay. Or a great multifamily company here, right? With a great multifamily sausage. And this price to book ratio, so 21 years to earn your money back, and 2.39 price to book ratio. What that means is if you invest $2.39 in to buy a share of this, you actually get $1 worth of real estate. That's what that means.
Yep.
And if you invest $1, you actually get $1 worth of real estate. Imagine that.
Right.
Imagine that. So private is the way to go. They're far superior in every way except one, liquidity. And there's even answers for that. Our process is very, very different. We are not the typical kind of investment advisor. In fact, we're not investment advisors at all. We are investors ourselves. And what we actually do is first look at key trends in play, where, in other words, what tides are going in, what tides are moving out. And we identify the investable tides, then we identify the best strategies to play those tides, the best kind of boat. And then we pick those investments and invest in those things. So very, very different. We have an extremely broad team with venture capital, hedge fund experience, private equity experience, real estate, oil and gas, and we bring all that to bear. So very, very different. And we're not advisors. We're actually investors. So every single deal we do, we actually put our own money in first.
I want to make one more comment too, just going back to the economic tides, versus the waves. I've heard you say this before, and a lot of people conflate the economy with the stock market, right?
Right.
And so the stock market is constantly oscillating, going up and down, and it's reacting to information that's coming out, and it's very emotional, right? But it's a lot of people think, hey, it's impossible to know where the economy's headed because they see the stock market fluctuations is possible to know. But the reality is a lot of these economic tides are long-term trends.
Right.
And that's what you really learn going back to that. And that's how we've positioned ourselves, finding
you can't predict the waves, but you can predict the tides. They're very predictable. In fact, demographics, for instance, is the biggest tide there is.
Right.
And it's highly predictable. So you can't resist it. And the public market is primarily narrative driven. What happened between 2000 and 2001 in the dot-com era? Did all the companies become valueless over, in the course of 6 months? No. Did Amazon suddenly become worth 99% less? No.
Right.
It's pure narrative and that.
Before we jump into the trends, I know you're all waiting to hear that, we wanted to just talk about this podcast we're doing. We started this about a year ago, having a blast doing it. And our whole goal with this is to do education like this webinar, but even more granular and more frequent for investors. And so what we found through our
For
research,
billionaires, right?
not for billionaires, but investing like billionaires, because what we found is that the ultra wealthy, the institutional investors, the family offices, they're investing a large chunk of their wealth in private alternatives, right?
Right.
They've been doing this for decades,
And
actually.
can the little guy do this for real?
Absolutely.
Yeah,
and
they can.
that's what we want. We want to help people feel confident to be able to invest in these types of deals.
Putting your money in the same things that the billionaires are.
Yeah. So if you like podcasts, subscribe wherever podcasts you listen to those. And, we love doing this and got a lot of great feedback from it. One of the things to do if you're not a podcast listener, but you want to stay up to date on what's going on with what we're doing, other webinars like this, our goal is to do these, every month or two. Sign up for our mailing list. Go to our website, aspenfunds.us, and you can sign up for our mailing list at the bottom. And you'll stay in the loop. We put a lot of articles together. We put a lot of videos together, a lot of podcast content. And we also, if you are looking to make investments, we have an investor club that you can apply to. And you can get exclusive content through the club membership, as well as early access to the deals we put together. And with that, let's get into trends. What are
trends?
they?
All right.
Man.
Number one, shocker, inflation, but I'm going to actually show you how it affects you and how to make money in it and how to not lose money. And here's my summary is we may have seen the worst, but definitely not the last. So our view is that inflation probably is not going much higher, but it also is not going to go back to the levels it was before, under 2%. It's going to be more in the 3, 4, 5, 6% range long term. So get ready for that. And here's why we think that. So the first thing is this, so some of inflation is supply chain issues. So when people can't get goods shipped overseas, it creates inflation. So there's supply chain issues that have contributed to inflation, but there's also energy and worker shortages. Now, here's what I want to show you, this little chart here. So this is the consumer price index, and here's the components. And look at this one right here. This is energy. So versus all other items. So where do you think inflation is coming from? And can anyone guess?
Right.
It's primarily energy driven. Okay. And the energy, so we're going to look and actually why is energy prices high and will it continue? The second component that is going up dramatically is in the employment costs. And if you look, this is actually the employment cost index, the wages and salaries. So of course took a dive here in the Great Recession, gradually climbed up. And then what happened? It's just skyrocketed. Mm-hmm. So wages are going up. And so that is a component of inflation that is not going away. And again, we can talk about that in more depth, but you're seeing the labor participation rate has dropped and people are opting out in this point. And so that is not going to quickly go down.
Right.
So inflation, is it your friend or is it your enemy? And you choose whether it's your friend or your enemy. So inflation is one of the greatest wealth creators and wealth destroyers in a generation.
Yep.
And so in fact, inflation is a massive transfer of wealth from savers to borrowers, massive. So what I did here is just calculated, I call it inflation magic, 8% inflation. So I just calculated $1. Let's take $1, you have $1 of savings or, $1 in your checking account. How much does that change? And at 8% inflation in 10 years, that dollar, what that dollar would buy today, in 10 years, that will cost $2.16. So the price is double.
Yep.
In just 10 years, just 10, and go up almost 5 times, 4.5 times in 8 years. Okay. So what you don't want to own is dollars because they're not buying as much.
They're going down.
So you don't want to do that. Okay. So the good side of this, if you are on the income side of this, so let's say you have real estate and you're charging rents. Well, guess what? So rents that are at $1 today will be at $2 in 10 years and $4 in 20 years. So guess what? If you're collecting rents, you're now on the good side of this. The other reality is debt. So if you owe $1 today, in 10 years, the dollar that you owe is only worth 46 cents. That's pretty good. borrow $1, pay it back with 46 cents.
Right.
Not bad. And in 20 years, you pay it off with 21 cents. In fact, I'll tell you a story. I was in Zimbabwe in 2007 when they had their great recession. I remember, them taking going to the gas station and with grocery bags full of money to fill up their tank with gas, with a grocery bag full of money. I was there. And the pastor told all the people in the congregation to go and borrow as much money as they possibly could and buy houses. And he bought a $300,000, very large, a house that literally he paid off a few years later with a few grocery bags full of money. So what's the lesson there?
Right.
So a lot of people in our day and age are afraid of debt.
Yep.
But in fact, the more debt you have, you realize that debt's being paid off by inflation. Now there's still smart debt.
Yep.
Right. So smart debt, you want to have debt that you can service. If you can't service your debt, you're going to lose whatever you borrowed with it, whatever you bought to right.
Yep.
And you want to make sure that it's fixed rate debt.
Yes.
But bottom line, I've been telling people, borrow as much money as you possibly can and buy things that are indexed to inflation. You like that?
I like that.
All right. Well, nominal rates are rising. Nominal rates are the headline rates. So, the Fed rate or the mortgage interest rates, which are now hitting 7% as we're talking. But real rates, or rates adjusted for inflation, are still negative. What negative rates mean is they're paying you to borrow. A negative interest rate means I borrow money from you. Instead of me paying you interest, you pay me interest. I borrow and then you pay me. Good deal.
Right.
So interest rates are still negative. What do I mean by that? Okay, so here is actually a chart of here's inflation. This chart up here. So hitting 8% today, and here's interest rates. And you see this is a 10-year treasury interest rates hitting, 3 or 4%. You subtract those two and real interest rates are negative. And this is true even if you're still at a mortgage rates, you have 7%, it's still negative. Right. So what that means is it actually makes sense to borrow money again, so long as you don't get thrown out of your position because you can't service the debt. You got to make sure you can pay the debt and get fixed rate debt. But
what's really interesting, if you zoom this chart out, the number of times in recent history, that we've had negative real interest rates is very, very few,
very tiny.
It's
extremely rare.
So this interest rates feel high, right? People are, oh my gosh, interest rates are 7% for a mortgage. But if you adjust it for inflation, we've not seen this.
No. And it's a money minting time. So it's literally back up the truck and mint money. By the way, who's the largest borrower? Who's the 800-pound gorilla of borrowers? Any guesses, Ben?
I've heard this one before. U.S. government.
The U.S. government. And so one of the things that happens to the national debt is it becomes inflated away as taxes rise, because taxes rise with inflation. Why? Because incomes rise with inflation. And that debt becomes less and less a percentage of the revenues taken in. So this is a little known fact that most, even very high debt to GDP ratio countries like America and others have rarely defaulted on their debt. When you print money that you borrow in, you really can never really default.
Right.
But two, inflation simply destroys debt. Right. So learn what the government knows and borrow money. Is that sounds heretical almost to some people, doesn't it? I mean, to some people, they're turning me off right now. They're saying this guy is out to lunch, but it's true. This is mathematics, right? Am I missing anything here, Ben?
No, nope.
Okay. All right. High correlation between real rates and cap rates. So real rates, again, are interest rates after inflation, and cap rates are basically the earnings on real estate. And so people are very concerned about cap rates if you're a commercial investor, and they are actually highly correlated. So it's a good time for commercial real estate as well. Why? Because both real rates and cap rates account for inflation. They're inflation adjusted rates. The other interesting thing here is that in spite of all this, tightening, because of the stimulus and because really incredible amounts of stimulus thrown into the economy and the consumer is still in very good shape.
Yep.
Now,
Very strong
the
employment.
lower parts of the market, the lower income segments of our society are really suffering because of inflation. But the middle classes and others have done quite well because of the stimulus. And so there's a huge amount of savings that happened during COVID, and there's a huge amount of excess savings. And that basically caused this retail boom to happen, the travel boom, and the property boom that happened, just in the last year. All right. So there's inflation. It can be your friend and it can be your enemy. You choose. Get on the right side of it. We don't determine the cards that we're dealt,
right?
But we determine how to play them. So this is the card we've been dealt. So get on the right side of it by getting, borrowing money and getting into inflation protected assets. Real estate's a great one, which we will talk a little more about. All right. Second mega trend. Here we go. And this is a shocker for so many people. And I love that it's a shocker. The more people are shocked means the opportunity is going to continue to exist, right? As long as people think this is off or wrong, it'll continue to be a massively mispriced asset.
Yep. And
so what's happened, a false narrative has produced 7 years of underinvestments, a false narrative. And so what's the false narrative? Okay. In 2014, a new energy narrative became dominant that fossil fuels had reached peak demand. We're post fossil fuels. That became the narrative. Literally everybody agreed. We were post fossil fuels. And this was the end of the Obama recession that just never quite ended. So demand was very, very slow. Meanwhile, production was high. And so we thought we've reached this point where there's a new narrative. Fossil fuels are done. Simultaneously, we have this global environmental initiative and ESG, which is environmental, social, and governments and kind of a movement focused not only reducing fossil fuel consumption. All right, let's not drive as many miles. Let's get more fuel efficient vehicles. Let's consume less oil. Wonderful. But they also focused on reducing supply. Let's not pump as much oil. Let's not develop as much oil, which is kind of nuts. Okay. And so reducing demand is great. It's going to keep prices low. Reducing supply will keep prices high.
Right.
In fact, it's not something they talk about, but they do desire high energy prices because it accelerates the transition. That's what they call it, from fossil fuels to green energy. So they want high energy prices. But here's the bottom line. So long-term investments in fossil fuel projects worldwide are down 55% from 2014. Literally globally, the amount of money that has gone into developing fossil fuels has dropped over half. So this is now 7 years on. And the problem with that is that you can't just flip the switch. It takes 7 to 10 years to develop an oil field.
Right.
So if you don't invest now, you guaranteed to get declines because this is a depleting asset.
Yep.
And if we start double the spending tomorrow, it wouldn't change a thing in this. So what's happened, we have a massive energy investment deficit. As a result, global production today is severely constrained with no prospect of rapid increases. So this is really an incredible opportunity for us. And here you can see this is the investment in oil and gas exploration and development, and just how much it's gone down. What's happening as a result of that oil production has not kept pace with post-COVID demand. Oil inventories are at record lows, so I'm not going to go into the inventories, but to suffice it to say, Goldman Sachs is predicting $140 oil. Who was it was predicting? JP Morgan. How much are they predicting?
It was $280
$280 barrel oil, which
right now right about
insane.
$80 a barrel. So that'd be yeah.
And here's what they said, which was interesting. They said supply remains inelastic to higher prices. I'll decipher that for those who don't speak Goldman Sachs. It says higher prices will not result in more supply. It doesn't matter if prices go higher, there's not going to pump more oil. Why?
Right. They can't.
They can't. The negative growth impulse remains insufficient to rebalance inventories at current levels. Again, I will translate. The economic slowdown will not end the shortage. So they're basically saying. and the market will not build sufficient spare capacity by the end of 2023. Meanwhile, there's been a temporary suppression of oil price because Biden, in order to, save his, the election, is dumping the Strategic Petroleum Reserve, which was designed so that we don't run out of oil in case of emergencies or war or something, but he's dumping it on the market to keep prices down. And so we're seeing a huge opportunity here. We expect energy to remain elevated into 2030. By the way, who's the guy who's investing in energy right now?
Warren Buffett.
Warren Buffett, his largest allocation, who is famous for buying stuff on sale, value investing. Yeah. Energy prices will not revert to normal even if the war ends, because the globe wants to de-Russify their energy. So here's our view: energy disinvestment combined with ESG and the global environmental movement's focus on supply reduction instead of just demand reduction ensures high prices will endure. Basically, they're going to keep squeezing supply to make high prices, as well as the 7 years of non-investment, of massive underinvestment, is going to mean there simply is no capacity. Right now, you see the politicians screaming, refine more gasoline. There's so much talk about a diesel shortage. It's all because of refineries. I don't think a new refinery has been permitted in the United States since the 1960s.
Wow.
And they can't get them permitted. Well, guess what? If you don't permit a new refinery, you can't refine more. If you don't refine more, guess what? You don't have more.
Right.
They're running at max tilt. They can't produce more. If you want more, you got to refine more. You got to build. You got to permit this stuff. So anyhow, the other thing. This is critical. Okay, everybody, get on the edge of your seat here. Listen up. Energy. So if I'm right, and energy prices are going to remain high, there's something you got to know. Energy is the mother of all commodities. You think about it, okay? Everything, all food that's grown is farmed by diesel-run tractors and combines and equipment, and it's all, the seeds are all shipped, and it's all shipped by diesel running, everything. So energy is the mother of all commodities. Everything takes energy. Copper, right. to mine copper, to mine lithium, to whatever you do, it's the mother of all commodities. So if energy remains high, inflation will remain high.
Yep.
This is the thing. All commodities require energy. And this ensures that inflation will remain stubbornly high until they solve the energy problem. And while the Fed is busy trying to stop, slow down the economy through a monetary policy, just raising interest rates, that's a very crude instrument. They also need to combine it with an energy policy and a labor policy. In my opinion, we should have smart immigration policy that allows people to immigrate. We need them, and that allows energy to investment, it rewards energy investment and accelerates it. So, what about the green initiative? Everybody thinks the green initiative is ready to go, and I wish it were true, right? We all do. But here's the reality today, and this is from Peter Zehan, which we love his book. Mm-hmm. Buy the book, by the way. Today, all fuels today are 83% carbon-based, 17% non-carbon. And that's after all of this, right?
Right.
So non-carbon fuels, it simply hasn't come. It's just not ready. Right. It's not ready. And by the way, all this non-carbon fuels actually require carbon to wind. You got to manufacture a turbine, right? Using steel in a steel mill with fueled by coal, and then you got to ship it with a truck that's running diesel, and then you got to erect it with a crane that's running diesel, and you got to do that every 10 years as that thing wears out. So this is what people
as they're pushing. Don't realize this, and they're pushing this green narrative, which at the end of the day, ultimately that's a great reality. But the problem is they're forcing this disinvestment into what we need now, and we're not even close to making a green energy transition. This is several decades away. And so you're creating this massive gap that is where we're in right now.
Right. So just as a point, so last year, 4.4% of US vehicles were electric vehicles. Awesome. But it accounted for 65% of global lithium mine production. So we can't double it.
Right.
It's not even possible. So everybody's talking about we're going to have all electric vehicles by so-and-so date. Well, these are people that haven't done simple math. They haven't done simple math. This is from the EIA, the global agency looking at clean energy. They're estimating just to meet what they want to create, we'll need 40 times more lithium than we have today. 40 times, 25 times more graphite, 20 times more copper. This is just to meet the goals that we've set lots of times. So it's simply not there. And by the way, to develop a lithium mine takes oil.
And by the way, what country has lithium that we're not mining?
Yeah, tons. I mean, it's a lot in South America, a lot in America.
A lot in America. And
Yeah.
they're not permitting new lithium mines right now.
No. So this is the energy slide. Energy is a very big deal and one of the biggest megatrends that you need to be paying attention to. All right, number three. Is your brain melted yet? So I did this once and everybody looked at me just. I probably need to take a breath.
Yeah.
And slow down. Deglobalization. You've heard about globalization. Globalization is over. And we are about to enter a deglobalization trend that has massive implications for our world. And so what happened is the world began to globalize, and right after World War II, 1945, accelerated when China entered the World Trade Organization in 2001, and global trade has just accelerated and all of it. But what's happened is we have over-globalized.
Yes.
Globalization is good, but we've over-globalized.
Yeah.
And so as you put it, what's the phrase you say? We've underpriced the risk of globalization.
Yes.
So, and what happened is we shouldn't be as globalized as we are. That's everybody discovered when you couldn't put a chip in a car, right? And you can't ship a car. So suddenly in 2020, supply chains had to be de-risked, and now supply security is paramount with Russia threatening grain supplies, oil supplies being threatened. I mean, all of a sudden you've got to de-risk your supply chain if you're buying seeds or wheat or steel or whatever. I didn't show this slide here. Here's the global, all these natural resources coming from all these different countries. By the way, China is the number one processor of all these minerals. Right. All right. So supply chains really matter. And what's happening is what people don't realize too. So everybody thinks it's way cheaper to get things made in China. It's becoming less and less true. Right. And not true. In fact, right now, there's not a big advantage. You can actually build a manufacturing plant in America, and your cost of manufacturing is fairly close to China. If you include robotics, and you include the cost of energy, and you include the cost of transportation. And so this is a shocker. So check this out. This is the average wage per month in China. Look at the red line here. Average wage per month in China. It's a 15-fold increase since 1999. Chinese wages are not that competitive anymore. They're actually automated and building robots as fast as they can. So China's greatest days as a manufacturing titan are over. They're done. And it's not just this. I'll show you why. I'll show you why. This is what people don't realize. This is the working age population, the red in China. It actually peaked right around 2010. So literally Chinese working age population is declining. It's declining. There's fewer people working, and it's going to continue to decline. In fact, almost half of the population of China will be retired 80 years from now. Almost half. So that means for every two people, one works. So two consume and one has a job. Yep. To consume, what has a job. So think about what that does. To consume means prices go higher because you get two consumers, and one producing means wages go higher. Because you only got one guy producing all this. So we're seeing worker shortage. We're going to continue to see that, and we're going to see in China really become a shadow of itself. So China is not, in spite of what Ray Dalio and others say, it's not. We're not all going to learn Mandarin, in the next century. This is a shocker of a chart, again, from Peter Zehan. This is actually shows the Chinese population age cohorts of the people born here, the number of people born in 2005, 2015, 2012, et cetera. And what you see here is there's no young people. And in fact, there's very, very few young women. And this is because of the one-child policy. There is not enough young people to sustain a population. And you're going to see this is what's happening. You're going to see a pretty massive population decline happening. So the world is deglobalizing. And what that means is that there's less trade, more reshoring in this country. Manufacturing jobs are coming back. And we'll talk about some ways we can hit on that. All right, Ben.
Yeah. So it all flows together, right? And this next megatrend is kind of a function of all these other ones combined and what's causing the industrial boom stage 2, we're calling it. So e-commerce has been a huge driver of industrial boom over the past several decades. As e-commerce has grown, the need for keeping inventory and for distribution and warehousing has massively increased. E-commerce growth has been very steady for the past many decades. And you can see here in 2020 actually spiked substantially as people were at home and they had to get things delivered to them. But it very quickly dropped and started to plateau. And we think that this trend is going to continue, where e-commerce growth as a percent of total sales in the economy will probably continue to increase, but at a much slower pace. People still prefer to shop in person for certain things. And so what's been the biggest driver of industrial for so long is starting to slow down. But at the same time, we're now seeing these other massive trends of reshoring, manufacturing, and re-inventorying being brought to America. And that is we believe, going to be another big booster rocket to industrial. And so this is an area you can see here. This is an interesting chart. The blue line is inflation over the past about 4 decades. And obviously it's been going up. And if you notice, all the lines are pretty close to above inflation.
This is commercial real estate.
Commercial real estate in different asset classes. And if you look at the red line here, that's industrial real estate. Look at that, how much it is separated over the past really 10 years. And it's been a very, very good place to be. These are values relative to inflation. And why is that? Well, this chart right here, it's really fascinating to see what's happening. So if you can see the different colors here, this is the number of completions, which means new construction of industrial projects being brought to the market. And that's the gray lines there. And then the orange lines are net absorption. So those are the new leases being signed and that new inventory of a property being leased up and being used, being absorbed. And so you can see here, it's been, pretty strong the past a little bit. In the past 2 years, you've seen record absorptions, massive record absorptions.
So record building. So there are more warehouses and manufacturing real estate coming online, but it's all being absorbed. And the net vacancy rate is dropping. This line here, this yellow line is vacancy rate.
So even though we're building more,
it's being absorbed
faster. So vacancy rate is dropping. And we think this is going to continue. So a great kind of case study here. This is something that you may have been seeing headlines on, right? Tens of thousands of Ford trucks are sitting in parking lots and they can't be sold. And so the primary reason is microchips, the computer chips that make these automobiles work, they cannot receive. And it is primarily from supply chain disruptions like you've been talking about. And so they have outsourced manufacturing of these critical component chips, and they cannot complete manufacturing of these cars to sell them. So they have about, I think it's 45,000 vehicles sitting in parking lots they can't sell because they don't have chips in them. It's over $2 billion of potential revenue that they can't generate. And you think about the motivation for Ford that I've read the other day, it takes 30,000 parts to make a truck, and if you have 29,999 parts, all you have is a very expensive paperweight, right? So they have these paperweights sitting there; they can't do anything with them. So how important is it for Ford to?
I want a chip built in America.
I need a chip, even if it's a little bit more. Maybe they're going to keep more inventory, right? Just-in-time inventory is a thing of the past for critical components like this. It's very, very important because they are leaving a massive amount of potential revenue on the table that they cannot sell.
Yep.
This is just another little chart talking about rent growth and vacancy rate, just again showing the strength of demand for these types of properties. And this is from Prologis. So one of the senior vice presidents there, they represent about 6,000 customers in supply chain logistics. And they're saying that their clients, just their clients, need another 800 million square feet of industrial space. The other big trend here, right? So we've got the re-inventorying, but we've also got reshoring of manufacturing. And so this one blows my circuits a little bit, because when I was in school, you're learning about globalization, you're learning about shipping jobs overseas and manufacturing, and that has been the case for many decades, but it has been really turned. And you can see here the projected number of jobs to bring back from overseas for manufacturing is projected to be 350,000 this year. It's just a massive turnaround as these companies are realizing, hey, we need to bring this back and we need to protect certain parts of our supply chain. This is another chart for manufacturing employment. You go back about 20, 30 years, the trend was pretty clear. Manufacturing jobs are going down. If you extrapolate that out, it's a very negative curve there, but it didn't happen. And we're actually seeing it start to tick up a little bit, where manufacturing jobs in America are needed.
On the rise.
On the rise. This is the other big thing we're seeing. So it was so interesting. All these things play together, right? Energy impacts inflation. And now energy is also impacting the need for industrial space. A lot of these companies that are overseas, especially in Europe, where they don't have their own reserves and resources to produce energy, they have to import all of it. Well, with the energy shock that they're seeing with the prices, it is becoming a huge variable and a cost that is untenable for.
So listeners may not be aware that America is the largest oil producer in the world.
Yep.
And in fact, America is the only country, the only industrialized nation with energy.
Yeah.
We're the only nation. So China does not have any. Japan doesn't have any. Russia, is not really manufacturing power. They do have energy. So we're the only one. So if you have an energy intensive industry or business, it needs to be in America.
Yeah.
For energy security.
Yeah. Yeah. And this is just an interesting survey that was done of asking companies, why are you reshoring, right? So at the very top are social, ethical concerns. These are, geopolitical risk and wanting to de-risk some of the issues that we're seeing across the oceans here. And Walmart is an interesting one. Walmart is requiring a lot of their providers
to vendors
to
build in America,
so that they don't have supply chain issues, right? Inventory is a big one. And then right there, gas and electricity. This is long-term cap rate forecast. We won't go into this right now, but basically, the long-term forecast of cap rates, which is basically a way to value properties and real estate especially, are projected to kind of stay flat and go down over time. And industrial is actually projected to decrease over the next 20 years.
All right. Our last mega trend, and then we will take your questions, is housing shortage. And 15 years of underbuilding. This is going to be a real short one, so bear with me. So what I did here is this is the number of housing units started divided by population. And what we see, this is all the way back to 1960s. You see that there's, kind of this range. And then all of a sudden, during the great financial crisis, housing starts just went to nothing. And they've really not recovered until just recently. They're only now just hitting the bottom of the range they were at for the last, 60 years. And so we're seeing a massive undersupply. There just has not been enough homes built. I love this chart from Marcus Millichap. It shows since 2000, the top line is what it costs to own a home per month. So this is your monthly mortgage payment. And you see, went up. Here's the bubble. And here's currently we're seeing this massive increase in both interest rates and prices. So this thing is just skyrocketed. And this is the price of multifamily rents. This is the price of apartment rents. And what you notice here is anytime they get very far apart, they shrink down. Either this one drops or this one rises or both. Because it's like this. Okay, if you can't afford to buy a house, what do? You rent. And if houses get cheap relative to rents, you'd rather buy. So anytime they get close together, you see the prices go up. And so right now we're seeing, this huge divergence. We've seen both rents go up and prices go up. And so our view, this is actually a really good time for real estate. We think in the next year, There's going to be incredible buying opportunities because there is a housing shortage, both multifamily and single family.
Yep.
And prices, because of interest rates, are going to be coming down. So it's a perfect time to be getting in the market and buying.
Okay.
We did it. All right.
I know. Got
So,
through all the slides.
Any of you don't have melted brains?
Give us some questions. So really anything related to what we've talked about today, or something that's on your mind related to economics, what's going on right now. But have a couple questions already. So let's just dive into a couple of them. This is from Samantha. What specifically in the energy sector should we be buying or investing in?
Okay, well, we love private. Okay. So although, Warren Buffett has been buying the public markets. So we just did last month, we actually bought an oil field and it's producing great returns so far. And we'll continue. There's a lot of ways to do that. But yeah, I actually think this is one where you can probably buy in the public markets by energy producers. And I'm not a stock analyst, so I really can't tell you that. But you have any comment on that?
Yeah, I would agree. I think, we don't deal much in the public markets, so we have read several articles where there's seems to be some pretty big mispricing on certain stocks. We can't recommend, we're not advisors at all, but we're obviously finding a lot of value in the private markets. What's kind of been interesting as we're diving into this space more, we're finding that a lot of money that used to invest in energy as kind of equity investors are not there anymore. And a lot of the producing companies are not, they're a little bit wary to take bank debt.
Right.
Yeah.
There was a huge crash in 2016 when the oil price crashed. A lot of these companies went bankrupt, the oil companies. So they're not wanting to take any debt. So they're actually selling off working interest to private investors like us. And,
Yes.
And so we can actually get in this place with well-operated oil fields, and because they don't want to do debt. Besides the fact that, little known fact, John Kerry has been busy running around trying to get banks to not to disinvest and not loan money to energy companies. It's kind of bizarre, but
Right.
that's a fact. And so huge opportunity. And whenever something is super hated yet needed, good time to invest.
Good time. I think
but honestly, get in our investor club. We have got a couple deals coming up.
Yeah. Another question, Austin. You're going to love this question. With all this info, where should a young person start? Small beginnings, but wanted to buy a good boat or be on a good boat, in quotation.
Come on,
would you suggest real estate?
Definitely. Go ahead. You answer that.
Yeah. So if you're looking, from a career standpoint, from an investment standpoint, I think, those are two different questions, but from a career standpoint, we think real estate's going to be a really great place to be for a long time. I think the best thing you can do, whether you go into the corporate world, whether you do missions in Africa, is educate yourself around investing, especially in real estate. It's one of the biggest private asset classes in the country. It's the biggest. And there is so much that you can do in real estate, and definitely would recommend that.
I'm encourage people to buy homes, and they're super pricey right now. So maybe you got to take a break on that or whatever. And, I think, let's say buy in the next, maybe year, hopefully prices come down a little bit and the mortgages come down, but good time to buy. A lot of friends, I know friends that have moved into an apartment and they own a home, moved into an apartment, and they're now Airbnb-ing their home.
Yep.
There's a lot of ways to make some money, but yeah, real estate is definitely going to be the place to play. There are also some Reg A Plus funds, and maybe you can recommend those later in the show notes or something.
And
Reg A Plus real estate funds.
Going back to the career side of it, you said, should I buy a good boat or be in a good boat? I definitely recommend young people going and spending a couple of years working for a really good company, and especially a growth company, because you're going to learn so much those first 3 to 5 years that you can really then take to that next place. So I see some people want to be an entrepreneur right out of high school or something. You really need to.
You're going to learn so much more to get around experts and people that are way smarter than you, way better than you, and learn from them, become a sponge. So.
Yeah. Great question, Austin. Way to go, man.
Love it. Go, Austin.
All right, Cameron, what's the name of the book we recommended? The Peter Zion book. It's The End of the World is Just the Beginning. And so a little shout out, because we've been talking about this, both Bob and I are reading it. It's a very lengthy book, but we're actually going to do some podcast episodes on it because there is so much good need in here. But to, our opinion is he's a little doom and gloomy, and he's missing.
He's made a couple mistakes. Yeah.
He's made a couple kind of mistakes. And so we're actually going to present what we think is really good findings in that book. And then we're also going to kind of critique a few things. Yeah. And we're trying to get him on the podcast. If you know Peter Zine, send him our way. But
come on, Peter.
Definitely, hey, read the book and then tune into the episodes that we do probably the next month or two to talk about where we think, he maybe missed it a little bit. But he has some very important trends that he's evaluating that we're tracking too. But
so he tracks the energy trends, he tracks the demographics, and he's really dead on.
Yeah.
We're going to see massive changes economically coming.
Okay. This is with Jay from Jay. With China losing its manufacturing advantage, do you see buying nations shifting to other low-wage nations?
Definitely. And we're already seeing this. There was a great article in the Wall Street Journal recently about a guy who's heavy into manufacturing, 2 decades building out a Chinese manufacturing arm, and saying, I'm trying to get out of China. He said 100% of my customers want me to stop manufacturing in China. I mean, who wants to help the Chinese Communist Party oppress people, right? But he says it's hard to do. There's no place to go. So Cambodia is not big enough. China's not big enough. They don't have a big enough workforce. Some of the inputs he needs for his business aren't there. But we're definitely going to see that, and we're going to see really the answer is going to be a lot America coming back to America, and it makes a lot of sense. Some big winners are going to be Mexico, I believe, and Canada as well.
Yeah. And part of it is, yes, they're going to be shifting to other low wage nations, but that's only part of the problem. The other piece of this is security and supply chain disruption. Right. So being able to have the critical components when you need them,
and not have a truck sitting there,
have a truck in a parking lot to be sitting, trying to get in the port for how many weeks or months. So it's definitely going to be some shifting, but a lot of that shift is going to be to the US especially for critical components. This is from Paul. How does the individual investor participate in these mega trends? And then what do we do as Aspen?
Join the investor club.
So what we do, we are not advisors. We run private equity funds, but we focus our funds for individual investors. So a lot of private equity funds only work with institutional investors or family offices.
What we've done, we've paid attention to all these mega trends. We're going out and busy finding great places to stick money, and we're personally putting our money in and inviting our friends to come along too.
Yeah. So one of the cool things is a lot of economists are, I'll say, just pure theorists. They just come up with ideas and theories, which is great. We all need that, but we're actually practitioners as well. So we go and do the research, but then we actually want to create opportunities, for ourselves. We see the opportunities being created, and we want to participate in them. We want our friends and our investors to come with us. So you can go on the website, like I said at the beginning, aspenfunds.us, join our mailing list, join our investor club, but you could see some of those deals as they come out. Expectations on single family home values the next couple of years, best case, worst case.
Yeah. There was a great quote here from, who I can't remember who did this here. I wrote it down. Moody's Analytics, I believe, said, we're expecting housing prices to retreat between 5 and 10% in the most overvalued markets. So the ones that took the biggest hikes up. If there is a recession, drops will be higher, maybe between 10 and 20%. Nationally, moderate depreciation in housing prices is coming, but not that much. So I 100% agree. I think we're not going to see, we're definitely not in a bubble. Okay. Housing prices, what happened in 2005 is extremely different from what happened now. We had extremely lax underwriting in 2005, 2004 or 5 timeframe. Not the same today. A lot of speculation. Most of the housing appreciation was speculation driven. People buying houses, if you saw Big Short, as speculative investments. Definitely none of those things are the same. We basically are seeing this is purely demand driven. There is a shortage. So it's not a bubble, but the housing prices have gone up too far, too fast, too far. And so we will see them come down. In my view, that's a good buying opportunity. You want, so you got this tide going up, tide coming in, and you got a wave that's going out. Well, that's the time to buy, right? Tide coming in, wave going out. There you go. It's a gift.
Yep. Part 2 of this question from Nathan actually is a great question. How do you reconcile the apparent housing shortage with historically high building of both single family and multifamily?
Well, it's not historically high.
Yeah.
So
go back to that chart, because that's where it's very interesting. So we're seeing a lot of building.
This is the housing starts. Historically, housing starts have been here relative to population, and now it's been down to construction. Yeah, new construction. So we're seeing massively underbuilt. There's been especially single family has been horribly underbuilt.
And this is adjusted for population, right?
Yeah.
So you have to keep in mind, population has been growing over the past,
Yeah. So now
year.
we got to play catch up. At some point, this thing will pop back up here, and then I'll be neutral on here.
Right. Great. Hope the next question here. Where do you see artificial intelligence and Web3 playing to make advantages of these megatrends?
Yeah, well, we're already seeing it with robotics. I mean, robotics is coming a long ways. We're seeing tons of. I mean, we're looking at, and what's happened is the job market has radically changed, and unskilled or semi-skilled labor is disappearing. It's being automated, right? So we're going to continue to see that. How many, 20 years ago, we had rooms full of customer service people answering telephones. Now there's so much web self-service, right? It's simply people would rather take care of themselves. So you see a massive shift to everything that can be automated is being automated. We're going to continue to see that.
What was the thing we saw the other day in that presentation? Was it Google AI Assistant? Was that the one that was booking the calls? You should Google AI Assistant video. And this was a couple of years ago, but this is crazy. Basically, a robot is calling on behalf of an individual to book a hair appointment. It has an actual conversation with a real human.
And they don't even know.
They don't even know. It was
like
crazy.
Booking a hair cutting appointment. It's kind of fun, but what it means for you. So it's super important for you that are younger to go become a knowledge worker. Basically just being a body that can fog a mirror is not going to be as valuable as a robot. And so knowledge workers are going to be in short supply and are always going to be at a premium. So you need to get your kids educated and get them to become knowledge workers, because this is a very big deal. I mean, I can't remember, I think it was Forrester said by 2030, 30% of jobs are going to disappear. We're going to be disappeared. At the same time, we see the labor participation rate dropping. So it's kind of two competing forces against one another.
Okay, last question, and we're about to open a whole can here, but what's your view on cryptocurrencies?
Wow. So I'm actually, something of an expert in crypto. I'm a computer scientist, so from Berkeley. So I am, I do know quite a bit about them. And I've always said, I said I'm actually very long-term bullish on Bitcoin until if it ever gets any utility and until it's replaced by whatever the next thing is. Okay. Because Bitcoin still doesn't have a lot of utility, except if you're a criminal. It has got tons of utility. I have said I think the future of crypto is Ethereum, and I've been saying that for the last 5 years, because what they've built is more of an infrastructure. It's not just a coin. Right. It's actually a whole ecosystem for all things blockchain. But I said they needed a change, and they just shifted to basically the proof of stake instead of proof of work, just far superior. So I think I have yet to see. I pretty much once a year I go and do new research. What's the latest breakthroughs in crypto, to look for something that is really going to put crypto. Everybody has to have crypto. Right. And I have yet to find it, unless you're a criminal and you want to have something offshore. But it does, it's kind of the new gold. It's replaced gold somewhat, and it is superior to gold in some ways, because it very similar in some ways, because they can't create a lot of it, right? Yep. It's got a limited supply, but superior to gold because you don't have to hide it anywhere, right? Though if you happen to lose your key, it's gone forever. So your mother could never do that, right? Never, so give her gold, never give her blockchain. But so I think I have yet to see the breakthrough demand technology, the breakthrough need for crypto, the breakthrough app, right? What's the killer app for crypto? I've yet to see it. I did see some questions just on our offerings and some of our income funds. If you have specific questions, feel free to reach out to us on the website, aspenfunds.us. We're friendly.
You can hit on the top of the website there, get started, and you can find a way to connect with someone on our team to chat about stuff we've got going on. Thank you so much for joining. This was really fun, and hope you enjoyed it. Got some good information out of it, and we'll be doing more of these. So please join our mailing list and stay tuned for the next.
Give us some feedback, and if there's questions that you would like, topics you would like us to discuss in future episodes, we're always looking for what people want to learn about and get wise on. So send those out.
All right. Thank you so much.